The last class we were doing sums on how to fit up and the cash in, and we'll wind up with the third unit. So that next week we can start with the fourth unit and complete the syllabus by the 25th of December. Okay. So this is the next sum that we are going to do today. ABC Limited has a machinery with a book value of rupees 6 lakh. So similar way, first what we do is we write what is given. Okay, so there is an old machine and there's a new machine. ABC Limited has a machine with a book value of rupees 6 lakh. So old machine's book value they've given. Book value is rupees 6 lakhs, which can be currently sold at rupees 2 lakh 50,000. Just it can be, or you can say the market value is rupees 2 lakh 50,000. So if we sell it, we will recover 2 lakh 50,000 today. I hope you are able to hear me. Life of the existing machine is 5 years and the salvage value will be 0. So after 5 years, its value will be 0. I think there's some technical. Right now. Okay, so to solve such sums, what we do is we find the cash flows. To find the cash flows, we need depreciation. So first we'll do working note on initial investment. They've told us to help the company decide depending upon the NPV technique. So for NPV, we need initial investment. So first we'll do that. So cost of new machine, rupees 12 lakh, less recovery from old machine. If we are buying the new machine, we are going to sell the old machine. So recovery from old machine We are supposed to sell it for 2,50,000. That is its market value as of today's date. This is the market value of the old machine. So once we sell, we will recover that much amount. So we will get initial investment 12 lakh minus 2 lakh 50. We'll get it as 9 lakh 50,000. So this is our first working note. The next working note will be on depreciation. They have told us to find working note on depreciation. Okay, they have told that straight line method of depreciation is to be followed. So the formula, they have not given the rate. We need to use the formula. Depreciation is equals to cost minus scrap divided by life of the machine. Okay, we have to do it for both the machines, the old and new, and then we have to find the additional or extra depreciation. So first we'll do it for a new machine. Depreciation for new machine. Cost is 12 lakh. Scrap they have told is 2 lakh rupees. That is after 5 years. 2 lakh rupees you can recover from it. That's the scrap value. And life of the new machine is 5 years. So divided by 5. So we will get depreciation as 10 lakh divided by 5, which is equal to rupees 2 lakh every year for new machine. Now we'll find depreciation for old machine. Old machine, we'll have to again put it in the formula. Cost, that is nothing but the book value of the old machine, which is 6 lakh. Salvage value is 0. If you don't sell, you use it for 5 years, your salvage value will be 0. 6 lakh minus 0 divided by 5, we'll get the depreciation for old machine, which is 1,20,000. Now that we have the depreciation for old and new, we can find additional depreciation, which is equal to depreciation of new machine minus depreciation of old machine. Okay, so we'll say additional depreciation is equals to depreciation of new machine was 2 lakh, depreciation of old machine is 1,20,000. So 2 lakh minus 1,20,000, the additional depreciation will be 80,000. Okay. Now this is how we calculated the um, depreciation. Now after this, we need to find using this tabular method the cash flows. So here we have it for 5 years this time. We don't need 6, 7, 8. So from 1 to 5 years. So first annual savings. Annual savings we have seen is given in the question. The annual savings is 4,20,000. So that is nothing but our income or our profit 4,20,000. We'll start with that. It is the same for all the years because it's annual savings means every year same amount we will save. Less depreciation. Remember here we are going to take the additional depreciation. Okay, so additional depreciation 80,000 we found out. 80,000, same for every year, because this is straight line method of depreciation. The amount of depreciation doesn't change. So 4 lakh 20 minus 80, we will get earning before tax, which is 3 lakh 40, and which will be same for every year, because 4 lakh 20 annual savings minus 80 depreciation. Now tax rate on that 3 lakh 40, 40% is the tax rate. 1 lakh 36, same way on 3 lakh 40, 40%, 1 lakh 36 every year. Earning after tax is 3 lakh 40, that is earning before tax, minus 1 lakh 36, that is the tax. You will get 2 lakh 4,000, same amounts every year, because 3 lakh 40 minus 1 lakh 36 we are doing. Now we have to add back depreciation, which is 80,000 rupees. First we deducted it, and now we are adding it back so that we can save taxes. So our cash flows will be equal to earning after tax plus depreciation. We are adding it back, which comes to 2,84,000 every year. So if you are seeing, it is the same amount every year that we are getting. So one shortcut way is you can also do it for a single year, first year, and use annuity formula and find the present value easily. Or you can do it this way for all the years. Now salvage value of the old machine was 0. New machine, in the 5th year we are having a salvage value of rupees 2 lakh. So only in the 5th year we will take this 2 lakh, because salvage value you get only when you sell the machine, and we are going to sell it in the 5th year. So salvage value is there. So now we have our cash flows. 2 lakh 84 plus nil, because in the first year there is no salvage value. Second year also same, but in the 5th year we have salvage value of 2 lakh, so it will become 4 lakh 84. Now they have told that the interest factor, cost of capital, is 15%. So at 15%, we need to see the table values and find the. So at 15%, we'll see the table values. First year it is 0.870, then 0.756. Just take down here 0.870, 0.756, 0.658, 0.572 and 497. 0.572 and 0.497. Now we can find the present value interest factor, which is nothing but cash flows into the present value interest factor table value. You will get the present value of cash flows for all the years if you multiply them. And then you need to find the total present value of cash flows, which is nothing but addition of all your present value of cash flows. So that is 10,51,652. We can now find the NPV. NPV is equal to present value cash flow minus initial investment. So NPV will be equal to present value cash flow 10,51,652 minus initial investment. We did a working note here. 9,50,000 is what we had got. So we will minus 9,50,000 from that. So you will get 10,51,652 minus 9,50,000. We will get 1,01,652, which is the NPV. 1,01,652. So this is how we calculate the NPV, and the NPV is positive. Therefore, the company should buy the new machine and save the annual savings, whatever they are getting in the cost. Okay. So this is how you have to do problems on how to determine the cash flows. Usually there will be problems on selling old and new machine only, getting new machine. So this was the second sum that we did now. We'll do one more and we'll wind up this particular chapter today. Just copy that here. Okay, let's go to the last sum of this chapter. Ojas Limited, Ojas Enterprises. I'll just try and expand it a little more so that it's visible for you. Okay. Ojas Enterprises is determining the cash flows for a project involving replacement of an old machine by a new machine. The old machine bought a few years ago has a book value of rupees 4 lakh and it can be sold to realize a post-tax salvage value of rupees 5 lakh. So if you sell it today, you can sell it for 5 lakh. Its book value is 4 lakh. It has a remaining life of 5 years, after which its net salvage value will be 1 lakh 60. If you use it for another 5 years and then sell, 1 lakh 60 you will get. It is being depreciated annually at the rate of 25% under the return down value method. The working capital required for the old machine is 4 lakh. And then they have given about the new machine. The new machine cost 16 lakh. It is expected to fetch a net salvage value of 8 lakh. After 5 years, when it will no longer be required, the depreciation rate applicable to it is 25% under the return down value method. And they've given the working capital of the new machine is 5 lakh. The new machine is expected to save 3 lakh rupees every year in manufacturing cost. The tax rate applicable is 40%. So we'll have to do it. The question is, should the old machine be replaced by the new machine? Assume cost of capital as 10%. So the similar way, we have to uh, write down what is given first of the old and the new machine. Whenever you write down, no, you'll get all the details at a single place. Otherwise, you'll have to again and again keep reading the question. Okay. So we'll see what is given first about the old machine. The old machine bought few years ago has a book value of rupees 4 lakhs. So its book value is 4 lakhs. Okay. And it can be sold to realize a post-tax salvage value of 5 lakhs. So its market value at which it can be sold today is 5 lakhs. It can be okay. It has a remaining life of 5 years, after which its salvage value is 1 lakh 60. So life is 5 years, and after 5 years, 1 lakh 60,000 is the salvage value that the machine will have. Now let's see what they've told about the new machine. The new machine cost rupees 16 lakhs. So 16 lakh is the cost of new machine. Again, the life is 5 years. It is expected to fetch a net salvage value of 8 lakh after 5 years. So after 5 years, its salvage value will be 8 lakhs. Then they've given the net working capital required for the new machine is 5 lakhs. So this is additional here. Working capital 5 lakhs. And for the old machine also they've given the working capital. Last line, the working capital required for old machine is 4 lakhs. So here also we have working capital 4 lakhs. Then they have said the new machine is expected to bring a savings of 3 lakh annually. So annual savings here is 3 lakh rupees. So this is what is given. Then they have told that the depreciation will be on WDV method and the rate is 25%. Then we'll have the cost of capital given there. So cost of capital is 10%. Tax rate is 40%. So these are the values given for all the machines. Okay, now we'll find one by one we'll do the working note. So first working note we always do on initial investment. when we go on initial investment, first we find the cost of old machine, new machine. So right here, cost of new machine, 16 lakh, 16 lakh total. Then less recovery from old machine. If you sell the old machine, market value is 5 lakh today, so you're going to recover 5 lakh. So you will get it as 11 lakh. Okay, but you cannot say 11 lakh is your initial investment. In this 11 lakh, they have also told about the working capital. Working capital is also an investment. So I'll just say additional working capital, not the total, because the old machine was also having a working capital of 4 lakh. The new one's 5 lakh, so it's only 1 lakh extra. Already 4 lakh we were investing in old, so that 4 lakh will be there. Plus 1 lakh extra the new one requires. So additional working capital is 1 lakh rupees. Therefore, we get the initial investment as 12 lakhs. This has to be added. So this was about the initial investment working out. Now we'll do 12 lakh initial investment. We'll do a working note on depreciation map, and then we'll do the estimation of that. Depreciation old machine, then depreciation at the rate of 25% for old machine, then new machine depreciation at the rate of 25% for the new machine, and then additional depreciation is old minus new. Okay, and here it's only for 5 years. In the question, they given the old machine value is 4 lakh rupees. Let's just cross check one. Old machine book value 4 lakh, new machine 16 lakh. So 4 lakh is the value. New machine it is 16. Okay, we have to find depreciation which is equal to on 4 lakh we have to find 0.25%, and we have to that comes to 1 lakh. So 4 lakh minus 1 lakh, the return down value is 3 lakh. Next year we'll take this 3 lakh. Again on 3 lakh we'll find 25%, and we'll do 3 lakh minus 75,000. We'll get 2 lakh 25,000 for the next year. On 2 lakh 25% is 56,250. If we minus it, the return down value is 1 lakh 68,750. So 1 lakh 68,750. Again 25% on that, we'll get 42,188, and the return down value will be 1 lakh 26,563. 1 lakh 26,563. On that again depreciation and the return down value. So this is what we get depreciation for old machine. Similarly, we have to do it for new machine. 16 lakh into 25%, and the WDV is 16 lakh minus the depreciation 4 lakh. So we get 12 lakh for the next year. So depreciation will be 3 lakh, and if you minus 9 lakh. Again, the third year, the value is 9 lakh. On that 25%, 2 lakh 25 depreciation, 6 lakh 75 the return down value. And 6 lakh 75 depreciation is 1 lakh 68 750, and return down value is 5 lakh 6,000. And for the last year, the depreciation net 26,563, and the written down value 3,79,658. Additional depreciation is this old new minus old. So new 4 lakh for the first year minus old 1 lakh, you get 3 lakh additional depreciation. For the second year, 3 lakh minus 75,000, 2 lakh 25,000. In the similar way, you will get the depreciation or the additional depreciation every year. Using this, we can find the annual cash flows for 5 years. Annual savings, they have told 3 lakh rupees, this 3 lakh every year. Then depreciation, we have to less. So first year 3 lakh, second year 2 lakh 25,000, third year 1 lakh 68,750, fourth year 1 lakh 26,563, and fifth year 94,920. So once we get the additional depreciation, we will do annual savings minus depreciation. So we get the earning before tax. Now we will do earning before tax into tax rate. Okay. Anything you multiply with 0 will become 0. First year you can see that there is no earnings only because the depreciation itself is 3 lakh, and of that 3 lakh your annual tax flow is totally gone. So first year you will pay no taxes, 0 tax. And for the next year you are going to pay the taxes. So earning after taxes, earning before tax minus tax, 0 minus 0 is 0. Similarly, 75,000 minus 35,000, 30,000 is 45,000. Now we'll add back the depreciation. We have saved the taxes. Now we want the cash flows. So 0 plus 3 lakh for the first year, this is 3 lakh. 45,000 plus 2 lakh 25, 2 lakh 70, and so on for all the years. Now the last year we have to also add the salvage value. So how much will be the salvage value? In all the two sums that I did, they had given salvage value only for new machine. But here they have given salvage value for both the machines. The new is 8 lakh and the old is 1 lakh 60. So we want additional salvage value. So working note on salvage value. So salvage value of new machine 8 lakh less salvage value of old machine 1 lakh 60,000. You get additional salvage value which is equal to 6 lakh 40,000. So we are going to take this 6 lakh 40,000 here as salvage value for the fifth year. Okay, now there is one more thing that we need to add here. We have given working capital also here, so we have to take add additional working capital. So we have seen in the initial investment only the additional working capital is 1 lakh, because working capital is something that will be recovered at the end of the life of the project. Working capital itself means that you are going to invest, sell the products, and recover back the money. So it is a cycle. You put in and it comes back. So at the end of fifth year, that additional 1 lakh is going to come back to us. So now we'll do cash flows. Cash flows plus salvage value plus working capital is any. That's there only in the last year. So last year cash flow will be a little high, like 57,969. Now we'll find the present value interest factor at 10% therefore. So at 10%, the table value is 0.909, 0.826, and 0.751, 0.683. The last, now you can multiply the cash flows with drag it for all the years. So you get the total cash flows as 14 lakh 34. As this is a positive NPV, the company has to buy the new machine and replace it with the than one. And these are the two. Any doubts, anybody? If, if anybody has any doubts, you can ask. If there's no doubts, you can type your numbers and leave the meeting. Next class, that is in the next week, I'll be starting with the fifth unit, that is on capital structure and leverages. So all of you can type your roll numbers and leave the meeting.